Hey everyone, it is Thursday, and you know what that means in our expert series. That means we bring back Jonathan Twomley. How you doing, sir?
I'm
Woohoo!
good. How are you? Woohoo!
Hey man, I'm doing well. I'm looking at all this stuff unwind, and when the data comes up, I think about you. I'm like, God, Jonathan and I are really nailing some of these numbers. And so let's
Mm.
talk about unemployment, kind of what we saw in claims and continuing claims today, because I think what we've been talking about for 10 weeks is starting to show up in the data.
Yeah, I mean, so unemployment new claims for last week were about 860,000, which is
Mhm.
down a little bit from the upwardly revised numbers from last week. Like
Cool.
the claims came in last week at 880 or something, and
Yeah.
then they were afterwards. They said there was actually more, which always happens, and people should be aware of that.
Yep.
This is always just a first draft, essentially, what we're talking about.
Yep.
The So they're down a little bit, which is good news, but they're not down enough for it to be really good news.
Right.
The claims have essentially plateaued in this $800,000 claim
Yeah.
level, and that is, if you look at Bloomberg News had a really good graph on their website today that shows the continuing claims going back a couple of years, and it's like flat, 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 and boom.
Bam. Yeah.
And if you just cut off the data series like from March, it looks awesome because you're like down, 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 down.
Right.
But what's good about this is it shows you how much lower the claims were before this all started,
Mm-hmm.
and we're like triple the or quadruple the claims from before COVID. So
Yeah.
this is going to start biting, and I think that, as you and I have talked about before, what's going on here is that we've kind of run out of low hanging fruit,
Yep.
right? The people who lost jobs because their businesses shut down during the lockdowns, but then were able to go back to work.
Mm-hmm.
They, they've mostly gone back to work. What you're seeing now is the claims from the businesses that have just been wiped out completely,
Yeah.
uh, and claims from, continuing claims from, say, businesses like my wife's that are completely tourism dependent, foreign tourism dependent, and
Mm-hmm.
the U.S. nobody's traveling to the U.S. So those kinds of businesses are continuing to take the hit, and either are starting to disappear, uh, or they're going to at some point, and they're still just hanging on,
Yeah.
in a state of suspended animation, like my wife's company.
Yeah. You were the first one to point this out to me. And I think you called it like 4 weeks ago. You're like, I'm afraid, and you called this early, so I want to give you a shout out. You called it before it was a trend. You're like, Michael, I think we're going to see a plateau right around 8 to 900. And that was when the trend was still like, decent acceleration down. So you called it. It's there. It's on record. So I like that. And what what I fear is we've now entered a new phase of new unemployment claims. That's what I fear. And what I mean by that is now we just have companies going, okay, I held on. It's been 6 months now. I'm tired of losing money, right? And they're like, here are the keys. I'm out. And, I got to let everybody go at one time. And that could be obviously in restaurants, in retail, in gyms, in cosmetics. And I mean, there's so many industries that are just crushed by this. But I really
Yeah,
fear we have the give up mentality. And I've been talking about for a long time that the rest of 2020 is going to be painful. And this is what I think it is. It's companies. I mean, there are companies that were generations in the making that I think go out,
yeah. Oh
and
yeah.
it's
It's
painful.
it's terribly sad. Yeah, and I mean, I think also the PPP running out, even though they're
Yeah.
talking about trying to restart it. I know this is like the Republicans are pushing that very heavily as part of their skinny plan that they want to
Yeah.
put through. But the I think there were a lot of companies that applied for PPP, and they basically were like crossing their fingers that by the time the PPP ran out,
Yeah.
that things would be back to normal, and this would be like a bridge. And I think that's
Yeah.
what it was intended at. I think it was intended to bridge the gap, but we didn't. We beat back coronavirus, but we didn't completely conquer it,
Hmm.
and now that's run out, and
Yeah.
maybe it gets extended. Even if it does, there's going to be that gap where some businesses just couldn't.
Yeah.
They could make it while they were getting the PPP, but they they couldn't beyond, they
Yep.
couldn't survive even a month or two. I mean, most small businesses can't survive more than a month without any revenue. And so
Yeah.
we're kind of, we had a stopgap. This is what I've been saying for the longest time. I feel like we have been living in this kind of twilight zone where the underlying economy sucks,
Yeah.
but we don't feel it yet because of all this money that's been pumped into the system to try to get us over the gap. And then it just might have been, too little, or, we weren't aggressive enough in the beginning trying to shut things down to really get the virus whipped.
Yeah.
So and this thing is like, this virus is like whack-a-mole too. I mean, even places like New Zealand that like completely shut it down still are occasionally getting little hot spots and flare-ups, and
Yeah.
they've been extremely aggressive about knocking those out. But if you even those places that were extremely aggressive about knocking out the virus, still you can get a new flare up anytime, right? We haven't beat the thing. There's no herd immunity. There's no herd immunity. I mean, Sweden doesn't have herd immunity. That was their thing.
Their attempt. Yeah.
Their attempt. They didn't achieve it. Their economy is in tatters like everyone else. So it's really just, we're going to have to just grit our teeth and continue to, muddle through this thing. But I think there's going to be a lot of carnage along the way.
Yeah.
And, and now with schools reopening, we have yet to see what's happening with that. But perhaps forecast of that is what's going on in Europe right now, or even though they did a much better job of us beating back the virus, they didn't wipe it out completely. And now that schools are reopening and they've also allowed, because they got their numbers down, they started opening the economy up again.
Yeah.
And now they've got a huge spike in cases, and some of the European countries are now basically back at record levels that haven't been seen since March. So they're going to have to clamp down again. This, we'll see what happens here, whether people make the decision, we're just going to live with it, or we're going to try to wipe it out. That'll probably depend on the state, what the politics are in the particular state. But who knows whether, honestly, I've given up trying to figure out which is better and which is worse. I think both are bad in their own way. And, when people start seeing other people getting sick around them, they're not rushing out to, the only people I see like rushing out to go to restaurants right now are people who are like, it's all a hoax. I don't believe in any of it, or no, you can't tell me what to do.
Yeah.
So, and I think people who don't have that kind of attitude and feel like, okay, this is something that we should take seriously, they're not rushing out to go to restaurants. And probably both of us are in the same situation where I feel like I'm willing to go, like, sit in a restaurant that's half empty, where they've got, the tables are spaced out and stuff. But my wife is like, I'm not letting you go.
Yeah.
Right?
No, I get that a lot. Yeah.
Yeah.
My wife is, let's just say we have a differing agree on the risk, but she happens to be the one that's a high risk, and you better believe I'm not going to be the person that gives it to her. So I'm not going anywhere. Yeah. Yeah. So there's a lot in that to talk about. So first, actually, let's go to the Fed. So I'm sure you read about it, the Fed announcement yesterday, last meeting before the election. A couple of things I took from it, see what you had. First, publicly, rates aren't going up to at least 2023. I'm going to say they're not going to go up all decade, but he can't say that. Second, he basically called on Congress to do their job, right? The American people need a additional stimulus. Do your freaking job. And he also updated GDP and unemployment to better numbers than last time, right? So, hey, the recovery's been a little better than we thought. Unemployment's a little better than we thought. But that's kind of what I took from the announcement. I don't know if you caught any headlines or had any additional thoughts.
Yeah, well, the thing that I picked up on was that he said that essentially it's all in danger. All this recovery is in danger if Congress doesn't pass additional fiscal stimulus. And
you're right. That is the key message. Yes.
And so, but it's kind of interesting to try to game this out, because all comes out and says, hey, look, the economy is better than we thought it was. then that's going to lead a lot of Republicans, who are the more conservative Republicans, to say, well, then what do we need more stimulus for?
Yeah.
Right. And so will the stimulus happen or not? Like, which, if perhaps if we really needed more stimulus, then the message should have been like,
Yeah.
like it's going to hell in a handbasket if you guys don't get
Get
your
off
act
your
together.
butt. Yeah.
So, but these are not easy times to navigate.
Yeah.
And we've got and we've also got, really mixed messages from the stock market and the housing market and all kinds of stuff that are just, I think, also making it more difficult to figure out sort of really where we are.
It'd be interesting on the stimulus front. So I feel better about getting a stimulus deal done this month than I did any time in the last 8 weeks. I'm on record saying it's not going to happen. They don't like each other. In fact, they always don't like each other, but now they don't even respect each other, right? There's pure hatred on both sides. But I think what's going to happen now is I think Trump sees that if he doesn't get a stimulus bill done, it really negatively impacts his chances. Because you can't have a really bad economy getting worse between now and November 3rd. And that's what I think he fears. And I think he's right. I think if he does nothing and he doesn't try, even if a stimulus bill doesn't get done, but he has to try to act like he wants one done so he can say, hey, look, it's them, right? They're the problem, not me, right?
Right.
I think it's a political game. I think this is all political theater. But again, I think this week I actually flipped. Last week, again, for 8 weeks, I'm like, there's going to be no fifth stimulus. This week, I'm like, oh, I think there's going to be one, because I think the Republicans, led by Trump, have come up to realizing, you know what, we need to do $1.5 trillion, maybe $2 trillion versus the skinny $600 billion. And I think that's game changing. I think they have to do something, right? They both want to send checks. They both want to do unemployment. They both want more testing. They both want schools. Really, the red line is helping the state. So I think if you take that out of it, a deal gets done.
Right.
That's what I think's happening.
Yeah. I mean, I think there is definitely there's pressure on Congress to act, and Powell's statement yesterday is, puts some fuel on that fire,
gasoline,
as well. Right. So maybe we'll see some additional stimulus. I think it's like, it's very tough for guys like you and me, who, even though we're different parties, kind of see things in very similar ways. Like it's just adding more debt and more, to this mess makes me uncomfortable. But
sure.
On the other hand, like, what other alternative do we have? Right.
Yeah. The option's not good.
Yeah.
I'm not sure I want to look into that abyss. But again, I think what's happening is we're starting to see the structural cracks that you specifically called for, started talking about 2 months ago, when the stimulus 4 was like a month from, like, you were talking about it, because I think it ended July 31st. You were talking about it early July, going, guys, pay attention, especially in multifamily space. You guys are in this never land, and we're about to have a problem. And we just got September rent collections as of September 13th, right? So, a couple days old, but they are their worst of the year. They came in at just over 86%. So, Jonathan, you nailed another one, and people need to pay attention, because that's a bad trend, because September's below August was below July, and it's about to get real painful.
I mean, we're not in like the doomsday scenario yet with multifamily, because there's still, if you're collecting at that, and it's still the middle of the month, and there's, even in good times, you always have your collections rolling in. There's always people who are, having a little trouble, kind of, especially in the C properties, kind of scraping the rent together, and they take some till the end of the month to get caught up. So that's always an issue. But and if you're at 86% in September 13th, you're probably going to be over 90 by the end of the month. You should be at that pace. So it's not like doomsday. You can survive on that. But frankly, if you didn't buy the deal right, or you loaded it up with so much debt that you can't survive at 90% collections, I mean, you really did something wrong.
Yeah,
But
that was a bad deal.
yeah, you really overpaid for that deal, right?
Yeah.
And I'm sure there are deals out there that can't survive.
I'm sure.
And that's particularly some of the ones that were purchased like last year at the top of the market. And they're, the theory was, hey, we're going to go do all this renovation, raise rents.
Yeah, the value add play. Yeah.
That is, those plans have kind of ground to a halt.
Mm-hmm.
And so like I said, not doomsday yet, but the trend is not looking good. And this is what I expected to happen just based on math, right? People get thrown out of work. They're, unemployment benefits, generally speaking, are not generous. They're not meant to allow you to sit around.
They're basically for
not
food.
Work.
Yeah, they're basically.
Yeah, it's basically it expects that you have some savings, and it's just helping you get over the hump till you find a new job,
mm-hmm.
which in a normal economy should only take you, a couple months. So, which is why they're limited to 26 weeks most of the time, right?
Mm-hmm.
So, but it doesn't really allow you to pay your rent for a long time, and the benefits are not particularly generous. So Congress topped it up with this additional $600 a week, and that was really what was allowing people to continue pay rents and collections to be strong. And we knew that was going to end July 31st. There was no replacement for it in sight. The president put together this $300 a week top up that was temporary.
Yeah, total Band-Aid, but something.
Yeah, but something, so that helped. But I mean, we're seeing now, not everybody got it. Not all the states were able to implement it. Even the ones that did took them several weeks to implement that. So, and some states didn't want to do it because they were supposed to put in money themselves, which they
mm-hmm.
don't have. So that was a little bit of a Band-Aid, but not really a solution. And now we're getting into that period where there's no additional help. And
mm-hmm.
I think this is where you're going to start to see big problems. You're going to start seeing that lower end of the renter base, which is A, disproportionately laid off, and B, and they work from jobs that typically can't be done from home.
Yep.
Or you can't.
They're selling hours, literally. Yeah. Physical hours.
You can't, you can't wait tables from home, right? You
mm-hmm.
You can't do a lot of these things from home. So those people are not only disproportionately laid off, but they also are disproportionately lacking in additional wherewithal to get over the hump out of their own resources. Yeah. So what we've been seeing this before with C properties, the stats that keep on getting tossed around about how strong collections are really only at institutionally managed properties, and that tends to be A and B class. There's been, especially in the last few weeks, some acknowledgement in those, the articles about those statistics that, hey,
I've seen
things may be worse at C properties, but we just don't know because, and anecdotally we have these anecdotes, but nobody's tracking it, so we don't know.
Right.
But I think what you're going to see and are starting to see is that sort of the lower end of the B, the people who stretched a little bit to be in those B properties, a lot of those folks are starting to run out of cash. And, we've still got this eviction ban in place. Some states still have it. The president imposed one that, has some reasonable conditions attached to it, but it still allows people to stay in their apartments without paying rent. And I think we're starting to, this is it, without a big stimulus bill from Congress that gives people that $600 a week again.
Yeah.
We're going to see some.
Yeah. We haven't seen the bottom yet. Yeah. I think that's, go ahead.
Yeah. No, I was just going to say, and the thing is, even if Congress does pass an additional stimulus, it's not going to go to like the end of 2021, right? It's not going until when, say, the CDC expects to really be able to roll out vaccines across the country, right?
All I've heard is they're talking end of year stuff, right? Basically to the inauguration, if they're, to the next 4-year presidency.
Yeah.
Yeah. So I think what I take from this, again, going back to all our conversations, which I appreciate, is without a new stimulus bill that is a check and unemployment, right? So those two things have to be in it, whether it's a skinny deal or a bigger deal, don't care. This 86% only gets worse. And we could very quickly get to 80% where you really start to have problems.
Yeah. I mean, at some properties, right? And also,
Yeah.
I mean, the thing to do, I mean, look, I mean, I don't know why I haven't said this before, maybe because it's just so obvious, but if this 86% number is across
Yeah. You have,
thousands of properties, right? This is an average.
yeah,
So that
exactly.
means you've got properties that are collecting like normal, like nothing has changed, right? You've got
Sure.
people who are, properties where everybody, you know, all the employees work for Amazon, and and they're all working from home, and they're getting
Yeah.
their paychecks, and they're not delivering from Amazon. They're
Yeah. They're in
they're
IT or something. Yeah.
they're in IT, and they're all doing it from home.
Yep.
And you've got properties that are probably down in the 70s, right? Because they are getting
For sure.
whacked because their employees work for Disneyland, not
Exactly. Or
or
casinos
or casinos or what have you.
or yeah, some
So
shale oil, whatever. Yeah, exactly.
right, exactly. With oil prices tanking, right?
Mhm.
So uh, so it's helpful to remember that this is an average number. This is so
Yeah.
your mileage may vary, right,
Yeah.
on this.
In your
Yeah,
experience, where does because again, 86% said earlier, hey, you should be able to carry it. It'll hurt. It'll be painful. You won't be able to do the capital improvements maybe you planned for, but you'll survive. Where does survival really become the issue? Is it 80% collection, 75?
yeah. I mean, yeah. When you're getting into the low 80s or 70s, then you're really up against it,
Okay.
right? So
Yeah.
um, the
I think we're there
like
next month if there's no stimulus.
for some properties, yeah, I think you may be. And the thing is, I think what also a lot of people don't understand too is that when you're dealing with commercial property,
Mhm.
just paying your debt service is not enough to make the bank happy,
Yeah, I
because
know.
they want you to be operating at a cushion,
Yeah.
right? And the cushion is 1.25 times your debt service plus the escrows that you have to pay every month. So for your tax escrows, insurance escrows, all those kinds of things, so your maintenance escrows, right? So they want um, you to be earning after expenses that much money.
Mm.
If you're dropping down into the 80s, there's a good chance that if you bought the property recently, if this is a deal you bought in 2009,
Yeah.
and then you're
You're fine.
or I should say it's 2020, so 2000 2010 2011,
Yep.
you're fine. Your debt service is very low.
Yeah,
You're paying
assuming
your
you haven't
rent.
refied it, which a
Yeah,
lot probably did.
that's true. But if you're still like at the end of your 10-year debt,
Yeah.
or when you refied, you just refied at the current balance, you didn't
Yeah.
take money
Rate and
out,
term. Yeah.
yeah. So if you're in that case, you've grown your rent so much that
Doesn't
you're
matter.
doing fine with your DSCR. If you bought 2018, 2019, beginning of 2020, like you may be
Yeah.
looking, into not making uh, that DSCR, that debt service coverage ratio. And what happens then, and I've been through this, and it sucks. The bank basically takes over everything, right? You
Operations. Yeah.
now,
Mhm.
I mean, they're not take over operations, but what they do is they seize all your bank accounts,
Ah,
and
okay.
all they do is they release to you your budgeted operational expenses, and that's it. And they keep everything else.
Oh, wow.
So that means if you have unexpected capex needs, okay, hey, investors capital call, right?
Yep.
Or if you have hopefully you have a separate reserve fund that you've built on the property you can dip into.
Mm.
But if you don't, then it's capital call on investors because there's nowhere else to get the money, right? You really can't do anything except just run the property at that kind of bare bones level.
Got
So
it.
anything that's any kind of spike in expenses or whatever, you're kind of out of luck. And even if you start bringing the property back, the bank is just going to hold on to all that money. So there's no, even if you're making a profit, it's all sitting in the bank's account, and you can't
Mhm.
touch it until you have 2 consecutive quarters of performance at a higher level. You don't even have, then they say, well, meeting the DSCR is not enough. You've got to beat it by, an additional 5 points or
Mm.
5 basis points, whatever. So
Wow.
um, it's very difficult once you get into what's called cash management to get out. And there are properties, even in good times, which you know, thank goodness I've never been involved in one of these, but I've heard about it from my management company that I use. Their properties are basically in cash management forever. Like they can
Oh,
never emerge from cash management because they can never get the performance, good
ouch.
enough. So this is something that, investors should be concerned about when they're looking at deals and thinking, well, how much can I pay? Like if the bank will lend you the money at 1.25, X your you know, your debt service, but
Mhm.
you don't want to be anywhere near that line.
Right.
Uh, this is not enough margin of safety for you. But I see a lot of deals, like I've been underwriting deals again recently, and I'm just seeing a lot of deals that are, first year, the way they're basically priced at that level. They're priced at
Wow.
you barely getting your debt, right? And then after that, like, good luck to you. And you can't make money on deals like that. So,
Wow.
and especially in this environment where we're seeing collections starting to weaken, it's,
Yeah.
yeah.
Yeah, well, I wanted to go. So I think it's a great transition from what we're just talking about rent collection, because again, it's a negative trend. We have some external forces that could make it better or worse, meaning the stimulus. But where I want people to realize is we have an example today of where it's not rent, but you'll get the analogy shortly, where rent collections have been way down, and now people are just giving the properties back to the banks, and that is obviously hotels. Right, hotels
Mhm.
have occupancy, I think they call it, below 40% in many cases for the last 4 or 5 months, and there are owners literally handing keys back to the banks because
Yep.
they can't afford them. And if we're not careful, right, and there's not another stimulus bill, this will eventually roll to multifamily, at least at some level, maybe not in mass like hotels, but it could absolutely happen. There could be apartments going back. Is that
Yeah. I
fair?
mean, listen, the hotels obviously are much more sensitive to the economy, right?
Sure.
And so, uh, this always happens whenever there's a recession. Hotels go bankrupt because if they fall below, I think most hotels need to be about 70% occupied on
Right
average
about. Yep.
for them to be in the black.
Mm-hmm.
So, and right now, they're way below that in most
Mm-hmm.
places. So there's a lot of hotels that are, giving up the ghost. But in multifamily, you could see that too. But I think where you're going to see it is in places that are really taking a big economic hit,
Oh
right?
yeah, for
So
sure.
they're definitely much more, multifamily is great because it is much more resilient than most other asset classes are,
Yeah.
just because people do have to live somewhere.
Yeah.
People do
Water,
have,
food, shelter. Yeah.
right. And people do have savings, right? Where a lot of people do have savings. The mistake people make is thinking that that means it's safe, or that means it's always good.
Right.
It's not always good. It's not always safe, but it is, yes, it is safer than other asset classes
Yeah.
that are more economically, directly impacted by the economy. Whereas multifamily is just kind of like a buffer in
Yeah.
between the
And
economy but still related.
yeah, so just to be clear, just so I don't get called out in the comment section, I'm not changing my opinion about multifamily. I do think multifamily, again, in the suburbs for most markets is going to do just fine because I believe we are seeing urban flight. We are seeing people's space is good. I think that's an investable trend. But this is a K-shaped recovery, and there will be some cities that get smacked. San Francisco and New York are the most obvious. Orlando could be a real problem. Las Vegas could be a real problem. Um, there are going to be some owners that lose apartments in specific markets, I think.
Well, yeah, but I don't think it's also even just market specific. I think it's class specific too.
Okay.
I think within, because of the patterns of who gets laid off,
Sure.
right? I think also within, um, markets, right, within metropolitan areas, even the ones that are receiving a lot of inflow,
Mm-hmm.
you're going to see a bifurcation
Okay.
of which apartments, you know, kind of sail through without much impact, and which apartments really struggle, and some of them, won't make it without changing hands or going back to the
Mm-hmm.
bank, right? So,
Yeah. Okay.
um, because just your C class apartments are going to have a harder time weathing the storm. And I know there's a lot of people out there who,
yeah, let's talk about, let's just scratch that a little bit. Cause I think there's even in C class, because I own some. So let's just be clear. I think there's really two kinds of tenants you could have in C class. So I'm thinking of a building I have, it's 20 units. It's, I want to try to be as accurate as I can. I think it's 70%. So that'd be 14 units are Section 8, where I would guess the average, because usually there's a split, right? The program kicks in a certain amount, then the tenants have a portion.
right.
So let's just use round numbers. Let's say it's 14 times 7. What's that? 800 or whatever it is. So I would guess the tenants are on the hook for $800 of that, and the program kicks in the other $8,000. I think those kinds of building that are already dominant Section 8 probably are fine, right? Because that money's not going anywhere, in my opinion.
Right.
But then there's another building I have that's 18 units that I think's 16 or 17 units are cash paying, which means only one Section 8.
Right.
I'm far more concerned in managing that building than the Section 8 building. Is that a fair classification?
Yeah, I think it's fair to point out that distinction as well. I mean, not just because of my own bias, I don't tend to buy Section 8. I'm buying, market rate C properties. So that's kind of what I have in my mind when I'm talking about it. But yeah, I think it's right now in this moment of time, if you are heavily subsidized by the government, that's certainty of payment, and that's why a lot of people actually like Section 8. Properties, even though they come with a lot more compliance, regulatory headaches.
Yeah, that headache looks really good today.
Yeah, I mean,
those yearly inspections, cool.
Yeah, you're restricted by how much you can raise rents and stuff like that. But on the downside, protection is there that like you're going to continue to get paid even at a time like this. So yeah, you will be more stable. So, but I think like the overall point that I'm trying to make here is that when people look at multifamily as like a monolithic, like a bond, like a treasury bill that's like going to get paid.
Yeah.
Right. You can't do that, right? You really, and especially now, more than I always say that people have to get granular and dig into the weeds and really understand what they're buying at all times. But now, especially, you really have to be really thinking hard about who your tenants are, how they get paid, right? And, what in a worst case scenario, what could happen to, because I think people need to really take the worst case scenario seriously right now.
I agree.
Because if we continue to have $800,000 a week, keep on making that mistake, 800,000 claims a week for new unemployment, the economy is not in good shape at that level, right?
Yeah, structurally it's broken.
Yeah, and again, maybe market depend. Some markets may be hit hard. It's always this way. Some markets are hit harder than others. Some submarkets are hit harder than others.
Yeah.
So some property classes are hit harder than others, and so you really have to dig in when you're buying property right now. And like for me, what I want to be doing, what I am looking for is, properties in high population growth markets that are basically solid Bs or better. Right.
I think Bs are the safest place to play. I think A's, you have financial flexibility and a lot of inventory coming, and then C's we've talked about. I think B's are the place today.
I mean, I came to this conclusion myself before COVID hit. And I think this is part of like the multifamily investor evolution, right? And I see this. I see this with people. Like I was always wondering, why are those people who are like 10 years ahead of me only investing in B property? Don't they get it? Don't they get it that C's make more money? There are higher cap rates and everything. And I was like, why? And then after running a bunch of C properties, then I had the light bulb go off on me that like, you're buying
I get it
C's
now.
You're buying C's at a higher cap rate.
Yeah.
But at the end of the day, you're probably not making any more money than you are with a good solid B property in the long run.
Yeah.
Because of all the issues of collections, evictions, deferred maintenance, all these things that you have on C properties that you have to a lesser extent on a B.
Yeah.
So my own, thesis was, hey, when I get back into the market, I'm just only looking at B deals, and
Nice.
I'm not, but now I feel even more strongly about that, because now what I'm thinking about is, before I was just worried about weathering a recession. Now we're looking at weathering, I mean, so,
Yeah, all this
uh,
stuff.
yeah. So if you're going to be buying deals now, you really have to be thinking very hard about, can your tenants pay, and can enough
Yeah.
of them pay, uh, if the worst happens, and what is your break even? And it's very difficult to do right now, because the pricing
Wow.
is insane still, because we've had these good collection numbers, and people, it's just like the stock market. I mean, stock market is at levels that nobody can really understand, right? All the real stock market pros are going like, this doesn't make any sense. These valuations are
It's
insane.
99 all over again. That's what I keep
Yeah.
hearing. Yeah.
And the same is happening in multifamily, where people are like, oh, collections are fine, full steam ahead. At the same time, it's a weird dynamic that I'm seeing right now, because there's very little inventory on the market.
Yeah.
The inventory that is on the market, people are going nuts over,
Wow.
right? And so, because there's a lot of people who want to buy, because they think, what the last 6 months have proved to them is, oh, multifamily can never fail. And just like in the stock market, oh, well, the feds will bail us out.
Yeah.
No matter what happens, we'll get bailed out. So full steam ahead. I think a lot of sellers, though, are looking at things going, I'm not sure I want to be selling in this environment, because I don't really know. People are going to try to get a discount from me. And it's everything is like, sort of, none of it makes sense to me right now. But prices are continuing to be very competitive.
Yeah. Very sticky. Very sticky. Yeah.
Very sticky. And people are paying it. That's the thing. What I predicted was that sellers would not lower prices, and that there would be a mismatch in the market. But what we're actually seeing is sellers haven't really lowered their prices, and buyers are paying.
Yeah. Buyers are stepping up now, which is very different than 3 months ago. Right?
Yeah.
Buyers are stepping up now.
And so prices remain high, but they're literally remaining high at levels where, you can't make a decent return.
Yeah. Well, I think like this whole conversation, I think I feel more strongly about the fact every topic we covered today, the rest of the year is going to be very painful, which will ultimately create opportunities, whether it's in hotels or multifamily or restaurants or office or blah, blah, blah. It's going to be interesting. So Jonathan, any closing comments as we wrap this week up? It's been a lot of fun.
Yeah, not really. I think, well, the only thing we didn't touch on was multifamily starts being down.
Oh yeah.
And that was something that I did want to point out, that,
sure.
Single family starts are up, multifamily starts are down. This is only 1 month of data, so it could be very noisy, but I think it kind of goes to where, you've been pointing out for months now that single family, that there's been some shift in consumer desires. We'll see how long it lasts, but at least at this moment in time, people want more space. They want single family homes. They're moving to the suburbs. The home builders are,
never
really
been this excited. 86 was their number.
Yeah.
Record. Yeah.
They're super pumped for this state of affairs.
Yeah.
And the multifamily builders are saying, hey, this may be not the best time to be throwing money into building more multifamily, especially since it's been like, there's so much money thrown into multifamily over the last several years. And some markets have oversupply problems at that Class A level. So I think that the multifamily builders are pulling back, and we'll see how long that lasts as well. Eventually that will help with the absorption, but if the economy is still declining, then it's a while for the demand to catch up. So.
Very cool. Well, thank you for bringing that up. Again, it's 1 month number, but it is a trend. Also, lumber prices are up 170%. That equates in a new home to about $16,000 in cost, which builders in today's environment just pass on to the buyers. I can only imagine what lumber costs do in a big old multifamily.
Yeah, that's a really important point too, that, that's for a big project, big stick built, 3-4 story, property with lumber costs going up by that much, it's a huge piece of your build cost.
Yeah.
And that has to be passed on to rents. And if you don't think you can,
you just back
because
off.
People are going to buy single family homes instead, then you're just not going to build.
Absolutely. So. All right, buddy. Have a wonderful day. I appreciate you. Have a good weekend. All right.
Yeah, you too.
Thanks.